all combined, we're producing around 19 million ounces silver equivalent on a yearly basis. This quarter alone, free cash flow, as you point out, was around $21 million for the quarter. We're building our treasury literally on a quarterly basis.
Quarter after quarter, have increased production, we have control, we have a disciplined approach to capital expenditure.
We are definitely very diligent and cautious on any dilution. A big group of friends and family ownership.
All right, today we're having a discussion with Arturo, the CEO of Santacruz Silver. Santacruz actually released their Q3 earnings just yesterday with a net cash flow from operations of $21.3 million in just one quarter, I should add. Now, we are comparing that to a market cap of about 100 million Canadian dollars on the stock market today, so that might just be a very interesting value proposition for you watching. Or at least, that's what we're trying to figure out today. So Arturo, it is great to have you on the channel. Welcome, and perhaps we can start off with a short and sweet overview of your business as it currently stands.
Absolutely, Stein. Thank you so much, and thank you for having me here with your audience. As you well point out, I mean, we just posted our Q3 financial statements, very strong ones. Actually, with today metal prices, the company's building a strong treasury and experiencing very strong cash flows. As of today, we have 5 producing mines in Bolivia, 1 mine in Mexico, the Zimapan mine, and all combined, we're producing around 19 million ounces silver equivalent on a yearly basis, right? So in addition to that, we have a trading company in Bolivia, which is called San Lucas. Through San Lucas, we purchase ore from different small miners, and then we process that ore within our milling facilities in Bolivia.
All right, thank you, Arturo. And I didn't give you an easy task, because when I grabbed the corporate structure as it currently stands, this is how it looks for the viewers at home. So definitely not an easy structure to get through, but we'll try to do our best in the 30 minutes that we roughly have to go through this. But before we talk about this, Arturo, perhaps we can actually talk about your Q3 financials. Can you take us through the numbers that are the most important to you from your perspective?
Absolutely, Stan. This was a good quarter. We've been building a strong quarters. Last quarter was a good one as well. We expect a strong Q4, and the most important things is we have brought down our liabilities. Debt has come down around $10 million in accounts payable. This last quarter, we announced in the restructuring with the Glencore purchase agreement, which definitely is giving us a lot of financial flexibility. That being said, and with today's metal prices, I mean, this quarter alone, free cash flow, as you point out, was around $21 million for the quarter. As an adjusted EBITDA, we reported around almost $16 million. So we're building our treasury. Just to give you an idea, from Q2, we reported around $7 million on our treasury. Q3, we just reported around $18 million. And as we speak, the treasury is significantly higher. So we keep building and getting the balance sheet stronger on a quarterly basis.
Yeah, it's definitely good to see that net working capital become positive this year. Very impressive. You referenced that purchase agreement with Glencore. Can you perhaps explain what it was all about and where it currently stands on your balance sheet on the liability side? Where are we at? Please remind us and explain the background of that.
Give you a little bit of history. Our original agreement was in 4 different concepts, if you allow me. One, which was the cash component, was around $110 million, which we should be paying on a $22.5 million basis on a yearly basis for the following 5 years after signing. And then we have an NSR in place for around 1.5%, which technically translates into around $8 million on a yearly basis. Then we have also the value-added tax, which was incurred by Glencore in previous years, which was around $58 million. That value-added tax was meant to be returned to Glencore whenever we collect that from the Bolivian government. And finally, we have also a payment of an inventory that was left, inventory of a concentrate final product that was left by Glencore, which was around $9 million. That was the original, or those were the original terms. Now the revised terms, which we announced, and it's part of our renewed balance sheet, is it's a very straightforward. We got rid of the NSR, no more NSR. We kept the inventory, which is the $9 million of the original inventory that was left. We don't have to pay that anymore. And we're keeping the value-added tax, which is around $58 million. So now all those three components are out of the terms. And in the other hand, you will be paying $40 million in November 1st, 2025, or you can choose and pay $10 million afterwards every year for the following 8 years. And that means considering $40 million at 15%, 15% interest rate over the following years. That's why it takes you to 8 years on a $10 million payment. We can early repay at any given time, but our idea is to actually pay in November 1st, 2025, the $40 million. Or we may even do that earlier if we're able to get a benefit from an early repayment. No? So that's one of the components. That's the catch component of the renew terms. And then you have another component, which are $77 million, which are conditional to the zinc price. We call these conditional value rights, CVRs. And how they work is if zinc goes north of $3,850 per ton, that's when this right or this condition gets triggered, and we start paying at that moment around $1.3 million a month to Glencore. If zinc comes down again, we stop paying at any given time at that moment. So that's the condition. No? We need to have the zinc over, and hopefully we start paying them sooner, because that means that we're going to be making a lot of money because zinc is at a very high price. No, that will prevail for 9 years. If for whatever reason we don't cover the $77 million over 9 years, that gets extinguished. So technically, those are the only two payments. Very straightforward. One is one that is very well under our control, the catch payment, where, as I was pointing out at the beginning of our call, we're building our treasury literally on a quarterly basis. So we feel very comfortable that we'll be ready to pay that on or even before November 1st, those $40 million. And hopefully, as I was pointing out, hopefully the sooner we start paying and the conditional value rights start kicking in. So those are the only two conditions. And as I was pointing out, in the other hand, you're keeping the value-added tax, which are $58 million. You're keeping the $9 million on the inventory. And you got rid of $8 million of NSR or royalties that you were paying on a yearly basis to Glencore. So this is a very straightforward, very clean structure. And that has been allowing us to strengthen our balance sheet and definitely take the company to a very positive working capital.
Definitely. Thank you for that comprehensive overview, Arturo. That was I think you were going to say it was a bit long, but it's perfectly fine. Thank you so much for taking us along with that. And like you explained, it is great to see that the balance sheet strengthening through that. I would like to take you back to the Q3 earnings. We need to talk a bit more about that, I suppose. First, cash cost, importantly, came in at around $22 and change per ounce of silver equivalent. Definitely strong cash flows there. Should we model that into the future as well?
Definitely. Actually, we're preparing the mines to be more efficient year over year. This Q3, we made a significant amount of investments. That's why you see our all-in sustain coming up a little bit from previous quarters. And the main reason we bought a lot of underground equipment for Mexico. We did 2 inclined ventilation raises in Mexico. Very expensive ones, but very important for the future of Zimapan mine. So we're making investments that our mines require to work and to be in a more, let's say, efficient way running for the coming years to come. And that's why you see our all-in sustain coming a little bit higher over this quarter. But it's technically preparing for the future and for better operations too.
Excellent. Well, thank you for tackling that all-in sustaining cost question. It's definitely something I've seen online on forums, for example, where people are asking where that's coming from, but that's capital investments for the future that you have to take into account of for today.
And actually, Stein, it's very important just to mention that this is the time of the year as well when it's for tax purposes is the right time for us to start making these, let's say, important investments, buying all this equipment. So it comes in a strategic moment for the mines, technically speaking, but also from a corporate point of view, from a tax point of view. This was the moment for us to start building and renewing our fleet of underground equipment.
Yeah, great to hear. So when we should, as an investor, model these figures, cash cost and all-in sustaining cost into the future, what kind of numbers should we calculate with?
That's a very, very interesting question. And we're aiming to bring this as down as possible, of course. And I will rather be cautious in a statement of a target at this moment. We want to give a guidance next year, actually. Stein, if you allow me, let me be cautious, and once we announce production budget for next year, we'll give guidance as well in the all-in sustain. We're reviewing at this moment, but I can tell you definitely it's lower than what you saw this quarter.
Excellent. Well, great. Thank you for that overview. Then I would like to take you back to the business and how it currently stands, and to this overview of your business. Here we can see multiple mills being listed. If I count correctly, we're at 4 in total. What kind of infrastructure is here? How much would it actually cost to build these mines if you were to start over today? What is the replacement cost of these assets?
That's a very, very interesting question, and the number is really high. Just to give you an idea, I mean, these assets, Mexico has a 3,200 ton a day mill, a facility that works at its efficiencies. It recovers the metals, silver, zinc, and copper here in Zimapan, as best as the metallurgical studies can allow us to reach. So these are efficient mills. Zimapan, I don't know. I mean, that's a good question, but definitely north of, I will say, close to $200 million just the milling facility, plus the underground infrastructure. I mean, you have 2 mines which are the ore feeders for Zimapan, and they are interconnected by a 7-kilometer underground tunnel, a 4.5 by 4.5 tunnel, which just a meter of that will be on the range of $1,200 today. So infrastructure at the mines is significantly important, and the mills, just the mills, I can tell you that are close to, I don't know, $100 million, if just to set round numbers. And if going to Bolivia, I mean, just to give you an idea, Glencore did a very good investment. As you can imagine, these mills have the best that money can buy, because Glencore never hesitate doing or buying the best equipment for these mills. So I will say that these mills, I mean, they are, let's say, half the size from what Zimapan mill is today, 1,200 tons per day. But I would say that if you want to build them from scratch, they will be in the order of $80 million nowadays. That's rough numbers, each of them. No, so and again, the mines have a very important infrastructure. Some of the pictures are in our corporate presentations, and you see those inclined shafts with very, very strong infrastructure. I mean, we're talking hundreds of millions of dollars just in infrastructure at the different mines.
Yeah, very interesting. Hundreds of millions of dollars in infrastructure, and an investor could, of course, invest in that company for $100 million, Canadian dollars on the stock market today. Could be an interesting value proposition, but of course, the mills are only worth as much as they can actually produce in material. We've been talking a lot about silver, and I think it's important to note now that you don't just produce silver. You express all your numbers in silver because it's the most important metal for you, but you're mining polymetallic resources. What kind of resources are we talking about? Also, if you translate it to life of mine, how many years can you run into current prediction of about 18 to 19 million ounces of silver equivalent a year? What is currently in the ground?
Yeah, good question. Let's say that on average we have around half and half silver and half zinc. Our composition of revenues today. No, maybe a little bit more in zinc at some of our mines, and revenues definitely come from those two metals. No, we have some copper in Mexico. It's not material, but we do have some copper, and we expect copper in Mexico to increase maybe 10% next year to, I don't know, something around 6,000 tons, 7,000 tons of concentrate, copper concentrate for next year, but not much, not more than that. No. So our main revenue drivers are silver and zinc. And life of mine, we just announced, and we filed our first technical report, 42101 resource estimate across all of our Bolivian mines. And they give you around 4 years of mine life on average. These are narrow vein systems where, as you might know, on a narrow vein system, having 4 or 5 years is not bad. We keep building our resources as we speak. So the idea is to always, get more and more resources than what you're mining every year, and or let's say return ratio, it's higher than our production. So we're confident that we'll keep building our resources.
Yeah, makes complete sense. You see this a lot in underground mining, where they have 3 to 5 years of resources and they continuously drill as they go deeper, as they go further following the veins, because it would just cost too much and would be super inefficient to drill years in advance. That makes complete sense.
Absolutely, yeah.
All right. Perhaps we can talk about the corporate vision and the low-hanging fruit that you have. So we know you have these assets and we know how valuable they are. And we also know how much cash they can generate. Just seeing this quarter, 21 million in net operating cash flow, truly outstanding compared to that market cap. What is the corporate vision for driving shareholder value in the future? Is it growth? Is it shareholder returns? Is it becoming a cash cow? How should we view your corporation?
Well, actually, that's a good question. And our objective right now is just to start achieving efficiencies across all of our mines. We have a perfect example, just to give you an idea, as you might notice in our news release and in the MD&A. We're switching one of the mines from Caballo Blanco. We're switching the production to provide that ore or to sell that ore to San Lucas. And the main reason is that blending that mine with ore from third party, it's more efficient than blending it with your own Caballo Blanco mines. So that, just to give you an idea, it increased the recovery of silver for around 5%. That is a few $1 million more on a yearly basis for the company overall. So those are the kind of efficiencies we're looking to achieve in the next coming years. That's why you saw as well this quarter, we pretty much renew our underground fleet in Mexico. And that is going to give us, of course, savings because you have lower maintenance expenses. And that's kind of the approach for the next year or next 2 years, to start taking these mines to reach higher and better efficiencies. And of course, that being said, improve our margins and keep building a very strong treasury.
All right. So growth through optimization, perhaps we should coin it as. Perhaps we can actually talk about shareholder returns at some point in the future, because your balance sheet is becoming very clean. You have now a relatively large cash position of $18 million at the end of this quarter. How are you viewing that? Should we perhaps expect a dividend in the future, or is that still a bit far out?
Well, as you point out, I mean, we have a strong or a very good balance sheet. We're building it and getting it stronger quarter over quarter. I'm sure Q4, as we're almost half there, our investors will see a stronger Q4. And actually, as you see, we have no bank debt. Our only debt technically is $4 million with Trafigura, which are being amortized in the next 3 years, $100,000, $150,000 a month. So very, very convenient, very relatively easy to handle. And the $40 million to Glencore, right? Which if we are able to get a benefit for an early repayment, we're going to execute that. But for the time being, our target or objective is to pay that in November 1st, 2025, I'm sorry. So with that being said, I mean, no bank debt, no streamings, no royalties. We're definitely ready to give our investors the best exposure to metal prices, to zinc and silver, definitely. No? So we expect that smart investors will start looking into the company, and eventually we should be reevaluated. No, I'm not the right person to set what's the right level of market cap, but definitely it's not $100 million. That's what I can be sure about.
No, and I'm also definitely not the right person to tell that. For the viewers at home, they should do their own due diligence, as always. In your previous answer, you referenced San Lucas, which is your trading company. You already referenced some benefits you get from it, better mix ratios and therefore better recoveries at some of your mines. But perhaps you can quickly give an overview of what San Lucas is and what the benefit is of doing this business for Santacruz.
Sure, absolutely, Sting. Actually, San Lucas is technically a trading company, or if you want to see it as an ore sourcing company for us, no, for our Bolivian assets. What we do there is we buy ore from small miners. First of all, we make a very thorough KYC process, and we make sure that they are producing or working in the best safety standards as possible. We even sometimes provide them with safety equipment and safety training. We make sure that they comply with let's say, universal values. No children, labor child at their premises, even respect to women and whatnot. So we try to definitely audit all of the, let's say, sides of the business, and once they approve to be our supplier, we start buying ore from them, and we process that ore in our milling facilities. We have 3 milling facilities in Bolivia, and what we do is that we run in campaign as campaigns its own patios to receive all the ore coming from the small miners. And once certain amount of ore is accumulated, San Lucas is designated with 1 week or whatever amount of days of each mill to run the ore that was brought to them. I mean, we blend it, and then we recover the metal contents and we sell that. No, it's a business for a marginal business. No? We always keep a margin, and we are cautious not to run any chances in terms of volatility of metal prices. No, so on the other hand, we hedge the metal contents for literally 1 month, which is what we take to when we pay the ore and we collect the monies after it's processed. So it's a very nice business. In addition to give us $5-7 million net on a yearly basis, it contributes to the communities. We bring all these small miners to the formal economy. We pay them to the banking system, and we retain the taxes for them. We pay those to the government, and in that sense, it contributes as well to, let's say, to the local communities, and for us also. I won't extend much, but it also gives us the ability to have our milling facilities running at full capacity the whole year round. If for whatever reason you have a hiccup in one of your mines or whatever, San Lucas is always ready to send ore to your milling facilities. So that's also important, no?
Yeah, I think it allows for a lot of flexibility. Like you explained, if you have a small hiccup in your mine planning, the mill doesn't need to slow down. You can keep it fed with the San Lucas ore. Very interesting. Thank you for the explanation. And that 5 to 7 million in cash flow a year is definitely a nice added benefit. Now I would like to take you to the balance sheet. We've already talked quite a bit about this, also with your amended agreement with Glencore. We've talked about your considerations payable, which was a post I wanted to talk about, $47 million. We already know all about that from earlier this interview. So there's one more post I would love to talk about, which is actually your loans payable. You already started hinting at it. There's a loans payable post of about $16 million on the current side of the balance sheet, so less than 1 year. Can you explain what this is and what are the terms associated with it?
Absolutely. These are mainly, the portion of, let's say, the Trafigura loan, which is around, give or take, $1 million. It's $100,000 a month for the next 12 months. So it's the current portion of that. And then you have some revolving credit facilities in Bolivia, which we use them just as cash efficiency, treasury efficiency, to payroll, to cover payroll, to cover power or energy, things like that. Just as part of your treasury day to day, no. So those are the kind of facilities we have, no. We use them every now and then, repay them right after. So technically, it's a revolving facilities, other than the $1 million from Trafigura.
All right, great overview, and I believe you also get a very attractive interest rate on that revolving credit facility from the Bolivian government. Yeah. So perhaps last topic on your financials that I would love to talk about is your share count. We've seen a very small growth since 2021. Back then you had about 305 million shares. Currently you have about 350 and change million shares. So relatively small growth, especially compared to the production growth you have done at that same time period. And perhaps we can just quickly talk about your point of view on share count dilution to fund growth. How are you looking at that? Should we model a bit of share count growth into the future? What are your thoughts on that?
That's a good question, Stein. And, as founders of this company, as having a big group of friends and family ownership, and also a few institutional funds supporting the company, for us, dilution is very sensitive. The last October warrants were not exercised. We were happy for that because no more dilution was taken into the share structure. So dilution for us is a sensitive matter, and we'll be very cautious on not incurring in any dilution, especially if it's not bringing any growth, right? You never know if eventually tomorrow we have an opportunity to buy something, and part of the financial plan requires some equity at the right moment and the right value. That might be something that we will evaluate. But definitely, to make the story, count the story short, we are definitely very diligent and cautious on any dilution from the equity side.
Perhaps we can include you very quickly with asking, what is the thing you're most excited for Santacruz Silver heading in 2025 from your perspective as the CFO of the corporation?
Look, Sting, I think this is a very nice story that we have here with Santacruz, because as you can see, we have a first quarter with a strong balance sheet. We have restructured the deal with Glencore, who has given us a better balance sheet overall. On the second quarter, we are as an income statement, we are producing income. That's the EBITDA. We're producing net income, etc. And third quarter we have cash flow. So it's a great story. And if you think about it, since we took over the companies in Bolivia, year after year we have increased our production here. So I think we have consolidated a very strong producer. We have focused on optimizing cost, etc. And as Arturo was pointing out, even though our priority now is to streamline these operations, we also looking for other opportunities to increase the asset base of Santacruz, but always thinking about getting value for the company, as we did here. We believe that we have took over these companies, we have improved them on operational basis, we have built a strong cash, and as Arturo is pointing out, operations are first for us. We know the finance part is very important, but as long as we have, as you can see in our cash flow from operations, basically most of our cash flows has come from cash from operations, so that is very good. Our debt is very small. We have only revolving credit as of now, and one of the most important things, and those credits are here in Bolivia and from two of the most important banks here. So that also showed the trust that the industry, the financial industry is having on us. We believe that we have a strong operations in Mexico. Sting, as Arturo has pointed out, that quarter after quarter have increased production, we have control, we have a disciplined approach to capital expenditure. Even though in Q2 you see an increase in Q3 increase in capital expenditure, those are very important capital expenditure that we have done. Once you get cash flow, it is important to strengthen your equipment and your mines, etc. And we did a responsible thing. We have also reduced our payables to our suppliers. If you look at our balance sheet, we have reduced it. When we took over this company, we have 27 millions in Bolivia to the suppliers. Now we have around 70 millions. That is very important because that allows us to have more manageable operations, better relationship with our suppliers, and because it's not easy coming from Glencore to a mid-tier company, but we have been able to do that. So I think the story is great thing here, and we will continue to do that.
All right, Andrés, Arturo, thank you so much for your time. Perhaps next time, Andrés, we can have you join a bit earlier, and we'll fire those financial questions to you as well. Thank you guys so much for your time. I really appreciate it.
Thank you, Stain. Thank you.